and welcome to BloombergQuint, a day of a new monetary policy review, an RBI press conference, governor talking about a bunch of things. The headline is, well, nothing's changed. The repo rate stays at 4%, the reverse repo rate stays at 3.35%, and contrary to some fears in the market, the guidance remains accommodative well into next financial year. Is that how the market is reading it, or was there fine print that they're taking note of? The final word on the market's view always comes from Neeraj Gambhir, who is a veteran, knows exactly what the market has read into this policy, and he's been kind enough to join us today. Neeraj, thank you so much for your time. Sort of a no surprises policy, in fact, maybe a positive surprise, because there was some fear that the dovishness would be toned down or the liquidity stance would change. I didn't note anything, did you?
No, actually, the language is exactly the same as it was used in the last MPC resolution. The fact that they will continue to remain accommodative through this year and maybe going into next year. I thought that there could be a little bit of toning down of that language, but they've chosen not to do that. So, and of course, there's nothing in terms of rates and there's nothing in terms of liquidity. So it's exactly the same, the status quo. It feels like that the MPC wants to wait and watch for a little bit longer to see how the growth parameters evolve and how the inflation evolves. Clearly, inflation is a concern, and not just the headline inflation, but the core inflation as well. But for now, it feels like that the MPC has chosen to sort of not be too much concerned about the inflation and continue to focus on growth.
A word though, Neeraj, on so if you look at the inflation forecast that they have put out, they have raised them. The contraction is going to be smaller than earlier anticipated. So while they're maintaining an accommodative stance, going by the forecast, it does not look like there will be any more option for a rate cut, at least if the inflation trajectory plays out as expected. So perhaps all they are doing right now with this accommodative stance is ruling out rate hikes.
That's correct. Even though the governor mentioned that whatever space that they have in terms of monetary policy, they are not able to use it right now because the inflation is a concern. And there was some mention about some level of accommodative, further sort of space available. But market's consensus seems to be that there isn't any. And at best, over the next, say, 4 to 5 to 6 months, we will continue to see a more of a status quo in terms of rates, and liquidity is going to be the main sort of focus of the market. How and in what form and shape Reserve Bank shepherds the liquidity in the system.
There was no particular guidance on that side either, right? I mean, one wouldn't expect them to explicitly spell it out. But the fact that Michael Patra talked about the fact that it's not so much the quantum of liquidity, but the distribution of liquidity, which is distorting or bringing down rates in the short-term corporate bond market and the treasury bill market, seemed to suggest that they are not overly concerned about this sort of lopsided rate structure.
Well, it's a bit technical in the sense that we've had this level of surplus liquidity in the system for a while now, and we cannot expect just the level of the liquidity to be creating these kind of issues. I think the issue is that in whose hand that liquidity is and whether they are able to deploy this liquidity in overnight instruments that Reserve Bank has for stabilization of the overnight market. So it's a bit technical issue from a very short term, overnight to, let's say, 3 months, 6 month rates are concerned. And I think the Reserve Bank can actually potentially address this separately and not just kind of bring it into the MPC framework. And I think part of the reason they might have chosen to do that is not to confuse the market, because anything that you do in the context of MPC could be kind of interpreted somewhat differently than what they probably want the market and the economy at a large to interpret. So I think for now they've chosen not to do something about this explicitly. I wouldn't rule out some steps here and there to kind of make sure that this doesn't become a bigger and more endemic problem.
But you do think it needs to be addressed? I mean, you don't buy the statement saying that we are not going to intervene with the markets. At least that's what Patra said.
See, under normal course of circumstances, the market should clear by itself. If Reserve Bank is borrowing money at 3.35, and there is no limit to that amount of borrowing, the banks can actually go and lend any amount under that window. The market should be clearing by itself, and that should have become the floor of the market. But clearly there is some friction in the market, and that is why it is not clearing. banks are not in a position to borrow this liquidity from mutual funds and lend it, in the overnight or term repo market. So I would think that some measures may be required, but probably for now they want to see and how this plays out before actually bringing in that toolkit at this point in time. Bear in mind that the governor did make a reference to the fact that there are tools available, and they would like to deploy these tools at the right time as they deem fit.
They did. There was a comment from Dr. Patra in the press conference where he said that the liquidity position is in line with the accommodative stance, and because the stance is accommodated, liquidity will be surplus. Actually, that's not consistent with what their own liquidity report had said, right? The liquidity report had said that in a corridor system, you should be in a mild deficit, except when financial condition warrants. So that was an exception, but the way he phrased it today, it almost seemed like the RBI has now moved back to the old system where if you're accommodative, then you have surplus liquidity, and if you're in a tightening stance, then you have deficit liquidity.
I think this sort of subtle change in the operating style as far as liquidity is concerned has come after a very long drawn and consistent feedback to Reserve Bank that you need to align the liquidity stance with the rate stance. If you recall, in the early phases of rate reduction, when the liquidity in the system was neutral, it wasn't really, the rate cuts were not really transmitting. So what I think the realization therefore has been that the transmission in the system actually gets a lot more facilitated and smoother if the liquidity stance of the central bank, particularly liquidity with the banking system stance of the central bank, becomes on the easing side as well, alongside the rate stance. So I think that's a realization that has happened through this entire 4 years of rate management.
Neeraj, they were very cautious in any comments they made, obviously on the FX side, but also on the foreign capital flow side. They did, though, acknowledge that there are sort of large capital flows that they're having to deal with. What's your sense of how they intend to balance allow the rupee to appreciate versus deal with the domestic liquidity consequences with the tools they have? How do you expect them to balance this?
See, my view around this is that the liquidity in the system is surplus. And whatever Reserve Bank is doing is basically adding at the margin to the surplus, though not in a much bigger way. If you see, the overall liquidity in the system is at about 6 trillion INR. If the intervention continues, it could potentially go up to about 7.5 to 8 trillion INR. But as far as liquidity management for Reserve Bank is concerned, 6 trillion versus 8 trillion is not that much of a difference, right? The tools probably would remain the same. At the same point in time, the need to make sure that there is an external competitiveness, particularly in the face of very strong capital flows, and the fact that our current account is in surplus, probably will likely be surplus for this year, albeit not very large, and the fact that globally the dollar is continuing to be quite weak against both DM as well as EM currencies. I think the choice to make sure that the currency remains marginally depreciative bias would require constant intervention, and the liquidity outcome is a outcome of that strategy. And if you can manage 6, you can probably manage 8 as well. So I think that seems to be the broad stance at this point in time. Obviously, we'll have to see how it evolves, as we progress through the rest of the year and go into the next year.
Neeraj, the last couple of questions on how we expect the markets to move from here on. So I think there hasn't been much of a move, at least on the 10-year bond yield, slightly softer today. But do you think this sort of 580 kind of level will hold unless we get a shock from the fiscal side in terms of any additional borrowings for this year, or perhaps then wait till the budget to understand what next year's stance will be?
See, my view on the bond market yields is that 580 has required a considerable amount of effort from the central bank. If you recall the past 2 policies and the interventions in between, they've been pretty significant. And the reason for that is that we are dealing with a unprecedentedly large amount of government borrowing program, both at the center and the state level. As we look forward into the next calendar year, and I think come January, February, market will start thinking about the next fiscal year. it doesn't feel like that the size of the borrowing program is going to come down in any way. In fact, our own house forecast for fiscal deficit is that we'll probably continue to be in the same ballpark as we had been in the fiscal year 2021. Now, if that is the size of the government borrowing program, I think the bond market will probably continue to be a bit on the edge to see what the central bank's policy stance is. And if it gets any sense that we are kind of getting into an exit mode as far as liquidity is concerned, or probably the central bank is getting more concerned about the inflation than the concern that they have shown so far, I would think that the reaction would be pretty swift. So I think it's a very, I would say, unstable equilibrium at this point in time. The market is quite concerned. But given the fact that we have regular intervention by the central bank, they are buying in OMO as well as they are doing operation twists. Liquidity in the system is good. Overnight rates are low. I think that's what's keeping the bond market yields anchored at this point in time. In the very near term, I think over the next 1 or 2 months, I would think that this 580, 585 zone continues. I don't expect the yields to cross 6% at this point in time.
When are you building in normalization, Neeraj? And by normalization, I mean both on liquidity and perhaps moving to a neutral stance from an accommodative stance.
I think we need to see Q1 of next year. The expectation is that the growth in Q1 will actually recover quite significantly. And obviously, there is a momentum that is building into the Q4 of this year. So Q4 of this year and Q1 of next year, we'll need to see. I would expect starting Q2 of next year, some kind of a formal exit from a very heavy, large surplus liquidity. Also, Ira, bear in mind that we are still looking at a fairly significant, surplus on the BOP front in next year as well. That's the forecast. So, which means that the problem of managing the rupee and the problem of intervention is not going to go away anytime soon. So it will take a lot longer than we would expect for the liquidity to be neutralized. But I think market will more focus on the forward-looking guidance from the central bank than the actual total normalization in that sense.
Neeraj, they've said there are a bunch of drafts coming our way, from drafts on a new CDS policy, on derivatives, on bond market instruments. Which of those are going to be important to watch? I'm fearing this onslaught of draft reports this evening, so I'm asking you which ones you're watching for.
Actually, it has been in the making for quite some time. It's a silent transformation, as I would call it, that the Reserve Bank has embarked upon in this financial year, notwithstanding the COVID pandemic. They have, introduced guidelines to allow structured derivative products. There is a revision on the comprehensive guidelines on derivatives, which is due. There is a draft of CDS, as the governor mentioned today, CDS guidelines that is due. So all these changes are basically a very quiet and silent, change in the way derivative, particularly the OTC derivative market works in this country. These changes will not have an impact immediately. These are big, longer-term structural changes. And I think these changes will evolve as we go forward over the next couple of years. But the important thing is that these steps are being taken in the midst of current crisis. And while that is not the headline item today, but from a bond market perspective, these steps are quite significant because some of these steps are actually coming after a hiatus of approximately 7 to 8 years when we didn't see much happening on this front.
Noted. Neeraj, thanks as always. Very kind of you to join us on BloombergQuint to share your perspective on monetary policy and interest rates. Thanks for watching.
Pleasure. Thanks for having me.